Good morning and welcome back to Almus Market Mornings. There are a couple of developments that markets would pay heed to. President Trump signed a directive to double import duties on steel and aluminum to 50% starting June 4th. The move keeps trade policy in sharp focus as markets weigh its impact. Meanwhile, an unexpected rise in US job openings gave a brief lift to sentiment ahead of Friday's payrolls report, though the JOLTS figure is known to swing sharply month to month. Geopolitical risks remain active, with Ukraine claiming responsibility for a fresh strike on the Crimean Bridge, prompting Russia to halt traffic on the key link. Good morning, JK. How are you reading all these developments?
Hi, good morning, Swaraj. Yes, I think the tariff issue lingers on, and there's no clarity at all on what is going to happen next, of course. And currently, as you said, the higher tariff on steel and aluminum has been confirmed with President signing the declaration, and I think market has not reacted much to this because it was already known that it was coming. What market is looking forward to is tomorrow's hearing on the appeal by the Trump administration against the ruling by the International Trade Court, making his reciprocal tariffs illegal. So that is the most important thing that the market is focusing on. Meantime, we have had, of course, the JOLTS data from the US, which showed actually a much higher number of job openings, but it masks the other negative factors in the data, because the quits rate, which indicates the confidence of employees to leave and find another job, has actually dropped. So lesser number of people are quitting jobs, wanting to feel secure in the current job. Similarly, the retrenchments have actually gone up. I think this is a situation where market is still waiting to see how the impact of the new policies will be shown up. And we have, of course, the ADP private payroll report today, and the non-farm payroll report on Friday. These will be better reflecting the overall situation, including the unemployment rate. But yes, I think my assessment is that sooner or later, these negative impacts of the policies will be definitely reflected in the numbers. Um, and because as we have shared earlier, the CEO confidence, or the investor confidence of the investors into new businesses definitely dropped, which means that they won't be spending too much on the employment side as well. Another important economic data that we saw was the Eurozone inflation. Eurozone inflation dropped to 1.9%. That is below ECB's target of 2%. And the core inflation, particularly the services side inflation, was substantially lower. And though this might be somewhat temporary, even so, ECB will be encouraged to go ahead with its rate cut of 0.25% when they meet day after tomorrow. Although there will be some caution about the future rate cuts. Some people are calling for the further rate cuts, but I think the ECB will be once again towing the same line of wait and watch, because the tariff impact will be assessed by the authorities before they take the next step. In any case, euro has not reacted much to this number, slightly lower from the highs, but it's still trading in the higher ranges, because euro, as we have shared many times in the recent days, euro has become the new safe haven along with the gold. So there's a lot of buying interest whenever euro dips. Important point that came up yesterday was also the OECD's annual report on global growth. Like the IMF, they have also downgraded global growth across the regions. The overall global growth is reduced from 3.3% to 2.9%, and major regions are expected to slow down. But for India, the growth from 24-25 is expected to 24-25 is expected to go up. So for calendar year 24, they assess the growth to be at 6.2, and for 25, they expect it to be 6.3%. And we know that the recent estimate by our government for full year growth of FY25 is at 6.5%, and RBI's growth estimate for FY26 is also at 6.5%. So India definitely continues to stand out as far as the growth picture is concerned, and so that's some good news for India. Overall, markets haven't really moved much yesterday. They have been in the well-known ranges of recent times, and the Japanese yen seems to be the one which is catching the attention because of the higher inflation that we have seen in Japan. And even yesterday, there was a statement from one of the BOJ officials that if the economy continues to perform better, I think they won't be hesitating to hike the rate once again. So only yesterday's data has given some correction to the yen on the weaker side, but otherwise it's on the stronger side. Overall, dollar, I don't think it deviates too much from the current ranges ahead of the key report on jobs ECB meeting ahead on Thursday, and the ruling on the appeals against banning of the tariffs also is expected. That is tomorrow. On the rupee side, once again within the range, no doubt, but some weakening bias is seen near term, as we have seen this last three sessions, right from 30th of May. We have seen outflows from FII, and overall outflow has now touched about 2.5 billion. And this is apart from the stake sale by foreign investors and bulk deals repatriation that we have seen. No doubt the demand is definitely much more than the supply that we are currently seeing. Market is only hesitating to sell around these levels because we had sharp falls from these levels last time around after the false break towards 86. So market remains cautious about selling, about buying at these levels. But if the weakening bias continues and if there is more selling from FIs, I think the genuine demand itself can take it towards 86, and that won't be a surprise. We'll wait and see what RBI does, particularly if the dollar index remains weak, whether they would allow rupee to underperform further, and giving some fears of inflation rising once again, imported inflation rising once again. So overall, expecting a rangy market in the global market as well as India, but a lot to look forward to on the data front and the policy decisions from today onwards. Thank you.
Thank you, JK. And just quickly summarizing, apart from the JOLTS data, we had the Eurozone inflation, which dropped to 1.9% headline figure, below the 2% ECB target. Though this might be temporary, but it gives some confidence to the ECB to cut rates. Though in the overall scheme of things, when you look at tariffs and that impact, the rate cuts would be requiring a further bit of confidence before progressing. There was OECD projections of global growth, which has been downgraded from 3.3% to 2.9%. Overall, markets have not moved much yesterday, remaining in well-known ranges. For the rupee, that remains in the range as well, with some weakening bias seen due to short-term outflows, including FII sales and some bulk deals and stake sales. That's it from us today. Thanks for listening. Have a good day, and we'll catch up tomorrow with a fresh round of updates.